The tech stocks are in a downward spiral. At the time I'm making this video, Amazon and Meta are almost 25% down over the last month, and Google is down 10%. Now the tech-heavy Nasdaq 100 is down 30% over this year, as opposed to the S&P 500, which is down 20%. Now, technology sector makes about 25% of the S&P 500, and out of that, Amazon, Alphabet, Microsoft, Apple, and Meta make up 20% of the market cap of S&P 500. And after the recent earning reports, the stocks are tumbling. Meta has lost over $700 billion in market cap and is at its lowest point since 2016. Along with Meta, Microsoft and Amazon are down too. The earnings report for these companies was not terrible. What's driving the stock down is the guidance report. That is what they project the company will do in the future. The growth for the tech stocks has been hindered by higher generated growth and also rising interest rates. As the rates are rising, the 10-year treasury yield at its highest point in 11 years. The continued increase in the federal fund rate is leading to the dollar being stronger. As the dollar gets stronger, these tech companies make less when they convert their foreign sales to US dollars. So today we're going to be seeing why the stocks for these tech companies are down and what did the guidance report show. So if that interests you, stay tuned. Let's get started. Hello everyone, welcome. This is Jaspreet Singh, and let's get started with our tech stocks. So we're going to be going through each of the major tech stocks individually to see what led to the stocks going down. Let's start with Meta. Meta is at its lowest point since 2016. Meta is telling us that they're making less and they're going to be spending more in the future. It's like at your job, your company told you, we're going to be cutting your pay, and with inflation, everything that you buy costs more. So your savings is going to be less and less. And that's the same thing happening with Meta. The earnings per share for Meta was $1.64, which missed the expectations of $1.89. The Q4 revenue projection for Meta is 30 to 32 billion, which missed the projection of 32.3 billion by the experts. And now Meta is telling us that they're going to be spending even more money in 2023. That scares the investors and leads to a stock sell-off. That's very important to note because 2021 was one of the most profitable years for Meta, and now they're telling us they're going to be making less money and they're going to be spending a lot more money. Meta's been spending a lot of money in their metaverse, and that's also part of the reason the stock is going down, because people are losing faith in the metaverse. That was the whole reason Facebook changed its name to Meta. And since changing its name to Meta, it has lost over $650 billion in market cap. That's just mind-blowing. Meta has lost almost $9 billion already this year, and they're projected to lose even more by the end of this year. People are spending less time on Facebook, and advertisers are also paying less for ads as well. And while making this video, Facebook just announced it's laying off 11,000 workers as well. All these reasons combined together is the reason the Meta stock is tumbling downhill right now. Aside from Meta, the stocks for other big tech companies are also down. Let's talk about Microsoft next. Microsoft has reported its slowest revenue growth in 5 years, with rising energy costs and decreased sales of its Windows software to computer manufacturers. The net income for Microsoft was $17.6 billion, which is 14% down from the previous year. Now, the earnings per share for Microsoft was $2.35, as opposed to expected $2.30. And the revenue for Microsoft was $50.12 billion compared with the expected $49.61 billion. So Microsoft not only met its earning expectation, it exceeded it. And despite that, the stock is still dropping. And the reason behind that is the guidance report from Microsoft and where the company is going to be in the future. The financial forecast for the current quarter is also falling short of the analyst expectations. And in their guidance report, Microsoft is also telling us they're going to be making less money and spending more. The dollar being stronger also hurts Microsoft because it does half of its business overseas. When it gets paid in these foreign currencies and it converts to the stronger US dollar, they get less dollar. So those are some of the reasons why the Microsoft stock is dropping right now. This will keep happening as the Federal Reserves keep raising the federal fund rate, which increases the bond rate, brings more money to the dollar and makes the dollar even stronger. So that's Microsoft and why that stock is going down right now. Next, let's talk about Alphabet. Google's parent company Alphabet has reported a decrease in profit of 27% from the previous year. They also missed the earnings mark They made $1.06 per share and the expected was $1.25 per share. The revenue for Google was $69.9 billion as opposed to $70.58 billion that was expected. So Google did miss its earnings report, but not by a whole lot. With the reports of advertisers spending less money on the platform, that's how they make most of their revenue, along with Google hinting at layoffs and cutting costs in the future, is leading to the stock dropping right now. Next, let's talk about Amazon. Now, Amazon stock plummeted 20%. When a company like Amazon stock drops 20%, something major has to happen. But it missed its earnings report by a fraction of a percent. Nothing that would cause the company to drop like it did. So what's the real reason behind the Amazon stock dropping? We're gonna explore more of that right now. So Amazon's expected earning was $127.47 billion, and it reported making $127.1 billion, which is a difference of 0.29%. Like I said, fraction of a percent. That was the most mind-boggling thing for me, that a company like Amazon stock can drop that much or such a small percentage. But that's not the real reason the stock is dropping so much. Amazon gave us a really weak guidance report with projected less holiday sales than the analysts had expected. Their cloud business growth has also slowed down since 2014. And with their guidance report telling us that their sales are going to go down, that means their expected earnings are going to go down as well, which is leading to the sell-off of the stock and drop in the stock. Not all tech stocks are doing terrible. Apple has been down 16% throughout this year. Over the last month has been creeping up about 7%. Now overall, global smartphone and PC sales are down, but Apple's demand remains high. The Apple loyalists are still there, and the demand for MacBook and iPhone remains there, and it's going higher and higher, which is leading to the Apple stock staying stable for now. Overall, the tech companies are telling us they're making less money in the US, and the money they're making overseas in the foreign currency that is weaker, when they convert to the US dollar, they're getting less money as well. They have less money to pay the wages due to inflation, and less ad revenue from decreased demand. Usually the tech companies lead and the stock market follows after. So we'll have to see how the stock market does over the next few weeks to few months. Alright guys, so there you have it. That's my take on the tech companies and why the stocks are dropping right now. And as always, I appreciate you guys watching, and I'll see you next time.